This short scenario introduces the core principles of financial accounting. It introduces the purpose of the profit and loss statement, the balance sheet, and cash flow statement. The profit and loss statement is sometimes called the income statement or statement of operations. The balance sheet is sometimes called the statement of financial position. We introduce the fundamental principles of financial accounting by considering a new company startup. Let us first estimate the revenue in this startup company. These revenue figures are estimates. Note how the revenue estimates follow the profile of a typical product life cycle. That is to say that the revenue in year 1 is low, then grows in year 2, peaks in year 3, and declines through years 4 and 5. Now let us say that on the 1st of January year 1, the startup company purchases an asset for $5 million. Financial accounting aims to reflect a true and fair view of the company's transaction. Thus the question now is, how should the company reflect a true and fair view of the purchase of the asset in the financial statements? The first option open to the company is to show the asset purchase at its full amount in year 1. This approach looks to be very true, and it reflects the full impact of the cost of the investment in the asset in year 1. If the company recognizes the full cost of the asset in year 1, there is no cost of the asset in years 2, 3, 4, and 5. Thus it will appear as if all the revenue recognized in years 2 through 5 does not have a cost of the asset. So even though the approach of recognizing the full cost of the asset in year 1 might be true, it isn't fair. Consequently, in order that the financial statements are both true and fair, financial accounts aim to reflect the cost of the asset over the period during which the company derives economic benefit from the asset. This period is referred to as the useful economic life. In our example, let's say that the useful economic life is 5 years. In order that the financial statements are true and fair, the company recognizes the cost of the asset over the useful economic life of the asset. This can be done on a straight line basis. The asset cost $5 million and has a useful economic life of 5 years. Taking a simple straight line approach, $1 million is recognized each year for the 5 years that we get economic benefit from the asset. For simplicity, this example ignores any other costs except those relating to the asset. The profit for each year is calculated by subtracting the cost from the revenue as shown. The balance sheet is prepared at the end of each accounting period. The balance sheet provides a snapshot of the values of assets, liabilities, and equity. For simplicity here, we'll only focus on the asset. The balance sheet will show the written down value of the asset. This is the cost of the asset less the expense for the asset that has been shown in the profit and loss. This expense is called depreciation. The written down value is also referred to as net book value. The asset was purchased on January 1st, year 1. The company used the asset for the year and showed depreciation of $1 million in the profit and loss. Thus, the written down value of the asset on the balance sheet at December 31st, year 1 is $4 million. For each year of the useful economic life of the asset, the company charges depreciation of $1 million to the profit and loss. The written down value is reduced by $1 million each year until the asset is fully written down at the end of year 5. Let us now consider the sale of the asset. Let's say at the end of year 4, the company decides to sell the asset. Even though the asset is on our balance sheet at $1 million, does this mean the asset is worth $1 million? The written down value is not necessarily equal to the open market value. The company will sell the asset at the open market value. Let's say we sell for $3 million. Question: if the asset is carried on the balance sheet at $1 million and we sell it for $3 million, is this a profit or loss on the sale? This is deemed to be an accounting profit. So even though we bought the asset for $5 million and sold it for $3 million, we made a profit. This highlights the fact that the balance sheet has nothing to do with cash. Like the profit and loss, the balance sheet is prepared on the accruals basis. The profit on sale is taken to P&L where it's shown as a separate line item. The asset is eliminated from the balance sheet. The cash flow statement records the cash inflows and outflows in the period. Our example will show only the cash paid and received for the asset. The cash paid for the asset is shown as a cash outflow in year 1. The cash received on the sale of the asset is shown as a cash inflow in year 4.